There are several big macro themes driving the markets this year. Strong dollar, collapsing commodity prices, the slowdown in China. Even with hiccups, it's been fairly consistent. So why are these macro hedge funds seemingly not able to capitalize on that?
There's been two themes in the ones that at least have gotten hurt, but in the main, it's been, being short volatilities. If you look at COMAC, if you look at some of the other funds, Fortress, COMAC got slaughtered by the Swiss franc releasing the peg. If you take a bet on a government doing something and you don't have any hedge against it, and that goes against you, these sort of lightning bolts can hurt, and being short volatility, is a tremendous risk. When we look at this fund, I don't know that you want to over extrapolate from this, from this fund's decline, from this fund's demise, I should say. I think they're probably 20 to 30 points under the index at this point. And BlackRock is a long-term thinking shop. Credit Suisse did a survey. They surveyed $700 billion worth of investors in hedge funds. The number one favorite category was global macro funds. And I think a guy like Larry Fink might look at his book and say, you know what, this is an unsaleable product. I need somebody in there who knows how to, who's got a saleable product. He's better off without one and starting new than you are trying to explain this track record. It's just cruelty of Wall Street.
Now, you mentioned that Swiss franc trade that caught a lot of people off guard, but that really speaks to the heart of the problem. Trades that have worked don't work. Bonds and stocks are now moving together. That created the algos to get all out of whack, meaning that there were all these external factors that markets no longer made sense in some ways. You would expect the Swiss franc to not have been depegged. You wouldn't have thought that in a million years. So, in essence, that did change the picture.
Well, I'll be arrogant and say that we can, roll back the tape, and actually that was one of my favorite trades, to sit there and say, eventually, currency pegs fail. That is one of the great lessons in macro, and it's been, we've seen that movie, it's like a Rocky movie. You watch it 8 times, but it's always the same ending, and somebody gets hurt pretty badly, and I think that's been the case. You just don't know when. And with respect to, the overall trending, you're right, actually, there, Alex. I think one of the big risks is people are over curve fitting. They're looking back historically. One of my favorite statistics is since Lehman Brothers, there have been 701 global rate cuts. Every time it's a rate cut. It's a rate cut. After the central banks do something 701 times, your model's going to assume 702, unless you are a really fundamentally based global macro person. And if you're using the algo, all your algos are going to be based on an unrealistic situation once rates have reached zero. 700 rate cuts around the world. If we still haven't gotten what you've gotten, odds are that the Fed is going to start doing something different, and your algorithm has to go back, half a decade to find the last time it made any sense at all, and that's going to be a real challenge.
Fabio, how do you objectively measure returns on macro hedge funds, the performance? Because you can't compare it to an index like the S&P 500 or the DXY. Do you just compare it to itself, to its own historical performance?
I think you compare it to, to total returns, and you compare it to its objectives and to its volatility levels. And, if we look at the BlackRock fund, you had quite low returns and actually pretty sharp volatility levels. And the reality is what people look at is, this is inside baseball, but the Sortino ratio, a ratio where you look at how much volatility on the downside, because funnily enough, if you have a 10% move up and another 10% move up, people don't mind about that kind of volatility. It's the 10% move down and the other 10% move down that gets you killed. So you look at really, how much return am I getting for the kinds of down market movements, that we're getting? And is this doing what it's doing, which is to be uncorrelated?
Well, also something that sort of comes to mind is that hedge funds have high fees. I mean, are we seeing investors interested in a macro fund, but they just want to do it and play it in a different kind of way because fees are expensive? Why pay up? Go somewhere else.
That too is a key point. And what's interesting is one of the things that's driven U.S. stocks has been this, TINA concept. There is no alternative.
Yep.
In a rising rate environment, particularly for someone like a BlackRock, as an aside, what precisely is going to work in your portfolio in this environment if we did see a legitimate rate cycle turn in the United States, or for that matter, substantial divergence? Macro is in fact the place that these guys probably want to be, and it is a challenging space to be in, and there are fees associated with it. There's, you can replace an index, you can replace a long only manager with an index fund. It's very, very challenging, or there's no real alternatives to human beings running macro funds unless it's an algo fund, and then it's going to be regressing against the 701 rate cuts, and you're setting yourself up up for a very difficult black box environment to do. In fact, you're seeing money coming out of CTA managers, out of the black boxes, and working more and more towards fundamental thematic investment rates management.